Higher superannuation contributions cap for those over 50. So if you're over 50, from the 1st of July 2012, the contributions caps are supposed to be reducing from $50,000 for those over 50 back to their standard $25,000 for everybody. But the government has announced that they're going to allow those people who've got a balance of less than $500,000 in their super to still maintain that $50,000 cap. And if you look at it, if you're on the 30% tax bracket, it's basically, 30% of $25,000 that you're potentially saving in tax, not 30%, 16.5%, over $4,000 in tax that you can save by still having access to that higher contribution limit if you're earning in the 30% tax rate, so between $37,000 and $80,000. So I just really encourage you. So the strategy that you can apply to this is this strategy called contribution splitting. And the whole concept of this strategy is that as, say for example, there's a couple and there's a main breadwinner and someone who's not earning as much income, they've got a lower superannuation balance. What you can do is if the higher income earner is ploughing $50,000 into their super each year and getting close to that $500,000 limit, or even if they're not, if they're likely to get to that over a certain number of years, each year you can split those contributions over to your spouse so that you can sort of maintain a lower balance in your accounts. The way that you do that, I'll see if I can just flick over to the Christian Super website. So I've just gone to the Christian Super website, so christiansuper.com.au. Just under the resource centre here, there's a section called forms, and if you go to that, there's a form on that page. It's called contribution splitting. So you can only do it once a year. So member contribution splitting form. So download this form here. It's basically a tax office form. It's basically saying that I'm going to split all my contributions over to my spouse. So the contributions less the contributions tax is transferred over to your spouse, and it can help you stay under that $50,000 limit. You just do it once a year. You've got to do it, often it's best to just do it at the end of the financial year, but before you complete your tax return. Particularly if you're getting close to that $500,000 or you're likely to get to $500,000 over the next few years, it's an effective way to maximise your contribution limits, reduce tax.